What asset accumulation means and why most people never reach financial freedom. Education only, not financial advice. Hi, I'm Cloud. Welcome to Cloud and Skye Finance, where we turn confusing money topics into simple, practical strategies. If you stopped working today, how long would your money last? Not how much you earn, not how busy you are, not how hard you work, but how long your assets can support your life. Because here's the truth, no one likes to say out loud, income does not create financial freedom. Assets do. Let it sink in. Income does not create financial freedom. Assets do. Today, I'm going to show you what asset accumulation actually means, why most people invest for decades but still feel financially anxious, and the real research-backed path toward financial freedom and a peaceful retirement, without hype, without gambling, and without burning out. What asset accumulation really means. Most people think asset accumulation means buying stocks, maxing out retirement accounts, owning a business someday. But in real life, asset accumulation means this: building income-producing and value-growing assets that can support your lifestyle without active work. Again, it is building income-producing and value-growing assets that can support your lifestyle without active work. That includes investments that grow consistently, assets that protect you from life shocks, systems that work even when you can't. If your investments collapse the moment life happens, job loss, illness, emergency, then you don't have assets. You have risk. Why most people never reach financial freedom. Here's the uncomfortable reality backed by data and behavioral finance. Most people fail because they skip the foundation. They invest before they stabilize. Common mistakes: investing aggressively with no emergency liquidity, locking money into accounts that penalize access, overestimating risk tolerance, underestimating life events. Studies consistently show that people sell investments at the worst possible time. Market losses hurt twice as much emotionally as gains feel good. Forced liquidation, not bad returns, is the #1 destroyer of wealth. So the real enemy isn't the market. It's poor structure. The asset accumulation pyramid, the right order. Let me give you a simple, realistic framework you can actually follow. Level 1. Stability assets, non-negotiable. Before growth, you need stability. This includes emergency liquidity, 3 to 6 months minimum, income protection, life insurance with living benefits, critical illness, disability, etc. Why? Because assets only work if you're alive, healthy, and solvent. Every wealthy family in history protected their downside first. This layer doesn't make you rich, but it keeps you from becoming poor again. Level 2. Growth assets, long-term engine. This is where traditional investing belongs. Stock market exposure, index-based investments, retirement accounts, business reinvestment. Key principle: consistency beats intensity. Research shows that time in the market beats timing. The market, dollar-cost averaging, reduces emotional investing errors. Long-term compounding works best when money is left untouched. This is where patience becomes a strategy, not a personality trait. Level 3. Cash flow and optionality assets. This is the stage most people never reach, but wealthy families prioritize. These assets provide tax efficiency, access without liquidation, strategic flexibility. Examples include cash value life insurance, used properly, income-producing real estate, businesses with systems, not self-employment, annuity-style income for retirement stability. This layer answers the question, how do I live off my assets without destroying them? The psychology of asset accumulation. This part matters more than returns. Behavioral research shows people abandon plans that feel restrictive. People succeed with systems that feel safe. Stress leads to poor financial decisions, even among high earners. That's why peace matters. A financially peaceful retirement is not maximum returns, perfect timing, zero risk. It is predictable income, controlled downside, flexibility in emergencies, confidence. You won't outlive your money. You're not investing to impress a spreadsheet. You're investing to sleep at night. The retirement reality most people ignore. Here's the retirement risk no one markets. Sequence of returns. Risk. If you retire during a market downturn and start withdrawing aggressively, your portfolio may never recover. Even good average returns won't save you. That's why modern retirement planning focuses on income layering, guaranteed versus market-based income, tax diversification, protection against longevity risk. Asset accumulation doesn't stop at retirement. It evolves. A realistic asset accumulation strategy. Example. Let's make this practical. A realistic long-term approach might look like Phase 1. Build emergency liquidity, protect income and insurability. Start consistent investing early, even small amounts. Phase 2. Increase investment contributions, add tax-advantaged assets, introduce protection plus growth tools. Phase 3. Diversify income streams, reduce volatility exposure, prepare income systems, not just account balances. Phase 4. Retirement. Shift from accumulation to distribution. Prioritize income certainty. Protect against longevity and healthcare risks. Notice something? No gambling, no hype, no shortcuts. Just structure, time, and discipline. Final truth and call to action. Let me leave you with this. Financial freedom is not about becoming rich. It's about becoming unbreakable. Asset accumulation is not a race. It's a system. If you build assets the right way, you don't panic during downturns, you don't sacrifice your future for short-term gains, you don't retire in fear, you retire with peace. If this video gave you clarity, like this video, share it with someone building their future, subscribe. If you want real financial education, not noise. And remember, build assets that support your life before life tests your finances.